I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing Canadian National Railway, a company we think might just be the best dividend growth stock in Canada. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me once again.
Always wonderful to be here, Nick.
All right, Ian, to start us off, Canadian National Railway has a long history of rewarding shareholders, but what specifically makes it stand out as a premier dividend growth play right now in 2026?
For sure. You could pull up CN's ticker. Current dividend yield, I must say, of 2.5% doesn't necessarily jump off the page, but I think this is where long-term thinking has to come into play because this company has an incredible track record of dividend hikes. It's consistently raised its payout over 25 consecutive years, including a 3% hike for 2026. Compound annual growth rate for its dividends regularly sat in the double digits over the long term, and that's easily outpaced inflation and helped to build its, again, long-term investors' wealth over that period of time. So if we think more in terms of effective yield, given the dividend growth that's occurred, people that bought this stock about a decade ago, they're currently enjoying a yield that's about double what the current face value is, and that's a great way to think about owning a company like this. You just sort of put it in your portfolio and leave it alone because this is a company that, despite it being in a very capital intense industry, really enjoys some favorable dynamics. First off, company enjoys significant economic moat, operates in a highly strategic, irreplaceable. They've got an irreplaceable network. Touches the Atlantic, the Pacific, Gulf of Mexico, you name it, CN Rail gets it there. And the astronomical capital requirements that are required within its business mean that there is not another railroad like it being built anytime soon or ever, frankly. And not only does it enjoy these competitive dynamics, management's really good at operating this business as well. There's a historic reputation here for maintaining an industry-leading operating ratio, recently bringing it down near 61%, meaning they are getting maximum profit out of their revenues. And that operational excellence translates into massive free cash flow that comfortably funds the reinvestments that are required into its network. It's a big share buyback company as well, and those reliable dividend increases that we have discussed.
Yeah, you think about that tri-coastal network, the Gulf of Mexico, the Atlantic, the Pacific. This is really the circulatory system of North America, and pretty healthy at that. If you look at those operating metrics, but in the current landscape, no business is without risk. Are there any near-term headwinds or valuation concerns investors should be aware of as they evaluate the opportunity to invest in Canadian National Railway?
For sure. I've likened CN Rail to the backbone of the North American economy. Circulatory system is a good one as well. Both are critical to the North American economy's survival. But yeah, I mean, as with everything, it's not without risks. First off, this is a company that generally demands a premium from the market. It trades at a relatively rich multiple, usually. However, now is not one of those times. Shares are arguably cheap right now. They trade for a touch less than 12 times EBITDA, which is below the 10-year average of 13 and nicely below the sort of the 14 to 16 range where the stock typically tops out. So means you might get some multiple expansion buying shares today as well to go along with the dividend growth and just overall earnings growth that CN enjoys. Bigger picture, though, I mean, railway business despite its importance, it is inherently tied to the broader North American economy, obviously, and that's cyclical. So it does sort of lead to dips, valleys, and peaks, and we can decide where we're at on that front another time. But typically speaking, this is just a company that you own through that cycle. Again, enjoying the dividend hikes, buybacks, and whatnot. And despite these cyclical bumps, the company has pricing power. It's essential and just provides a resilient core holding that investors do tend to flock to when cyclical dips occur. And I think arguably we could be looking at one right now.
Yeah, so you have a really cornerstone part of the North American economy trading at a cyclical, maybe low of its valuation, where if you're looking for income over the long pull. You can expect that dividend to increase over time. The kind of stock you probably want to have on your short list if you're looking for dividend growth in your portfolio. All right, that's all the time we have for this edition of the 5-Minute Manger. Reminder, if you want more stock ideas from us, click on the icon in the upper right of your screen. Thank you for joining us for this edition, and we hope to see you next time. Cool one.